You find a dividend stock that looks interesting. You want to research it properly. You click on the Financials tab, and then you see this. A wall of numbers, accounting terms, and categories that look like they're written in a completely different language. Intangible assets, deferred tax liabilities, accumulated other comprehensive income. Most investors look at this, close the tab, and either buy the stock based on gut feeling or give up entirely. Both are expensive mistakes. Today, I'm changing that. By the end of this video, you'll be able to open any public company's balance sheet and read it like a story. Not every number, not accounting at a professional level, but the critical numbers that reveal whether a company is financially strong or quietly fragile. And once you can read balance sheets, you'll never have to invest blind again. The balance sheet doesn't have to be intimidating. Once you understand its structure, which takes about 5 minutes, you can read any company's balance sheet and immediately spot financial strength or weakness. In this video, I'm going to teach you the 3 sections of every balance sheet, the specific numbers I look at after 10 years of analyzing stocks, 5 key ratios calculated from the balance sheet that reveal a company's true financial health, and how to use all of this to make smarter investment decisions. Let's build this skill. Quick disclaimer, everything I share is purely educational based on my personal investing experience. I am not a licensed financial advisor, accountant, or CPA. This is a simplified introduction to balance sheet reading for individual investors, not professional accounting training. The concepts I cover are intentionally simplified to give you practical investing insight. The companies I use as examples are for illustration only and not investment recommendations. Always research comprehensively and consult qualified professionals. With that clear, let's learn to read balance sheets. A balance sheet is a financial snapshot of a company on one specific date. It answers 3 fundamental questions. What does the company own? What does it owe? And what's left over for shareholders? The entire balance sheet is built on one fundamental equation that has never changed in hundreds of years of accounting. Assets equals liabilities plus shareholders' equity. In plain English, everything the company owns equals everything it owes plus everything shareholders have put in. This equation always balances, always. If it doesn't balance, there's an error. This is why it's called a balance sheet. Every balance sheet has 3 main sections: assets on the left or top, liabilities below or opposite, and shareholders' equity at the bottom. Let's go through each one.
Let's start with assets, the left side or top of the balance sheet. Assets are everything that company owns or is owed. They're divided into 2 categories based on how quickly they can be converted to cash. Current assets are things that can be turned into cash within 1 year. First, cash and cash equivalents, the most important item. This is actual money in the bank. More cash means more financial flexibility and safety. Second, accounts receivable, money that customers owe the company for products or services already delivered. Third, inventory, products that have been made but not yet sold. Non-current or long-term assets are things held for longer than a year. Property, plant, and equipment, called PP&E, covers all the physical assets like factories, machinery, and buildings. Intangible assets include things you can't physically touch: brand names, patents, software, and customer relationships. Goodwill is a special item that appears when a company acquires another company at a premium above its book value. The excess paid beyond book value goes here. One thing to note, goodwill and intangibles can be written down if an acquisition doesn't perform as expected, which is called an impairment charge. It's important to know these exist when reading a balance sheet. When I look at the assets section, I focus on 4 things. First, the cash position. How much cash and short-term investments does the company hold? Companies with large cash reserves can survive downturns, fund growth, pay dividends, and buy back shares without needing to borrow. Apple famously holds tens of billions of cash. That's a fortress. Second, inventory trends. If inventory is growing significantly faster than revenue, products might not be selling as expected. That's a yellow flag worth investigating. Third, accounts receivable growth. If what customers owe is growing much faster than revenue, customers might be taking longer to pay. That can signal collection problems or aggressive revenue recognition. And fourth, overall asset efficiency, measured by the asset turnover ratio, which is revenue divided by total assets. This shows how much revenue the company generates for every dollar of assets it owns. A higher ratio generally means the company is using its assets more productively. Compare this ratio to industry peers rather than looking at it in isolation. Section 2 is liabilities, everything the company owes to others. Like assets, liabilities split into current and non-current. Current liabilities are due within 1 year. Accounts payable is money the company owes its suppliers. This is actually normal and healthy in the right amounts. Short-term debt includes loans maturing within 12 months. Accrued liabilities are expenses the company has incurred but not yet paid, like salaries earned but not paid until next week. Deferred revenue is interesting. It's money customers have already paid the company, but for services not yet delivered. This is actually a sign of business strength since customers are paying up front. Non-current liabilities are debts due after 1 year. The most important for investors is long-term debt. This is where bonds and bank loans with multi-year maturities appear. Pension obligations represent money owed to retired employees. When reading the liabilities section, the critical question isn't whether debt exists, it's whether the level of debt is manageable relative to the company's earnings and cash flow. Some debt used wisely to fund growth is healthy and smart. Excessive debt is the #1 cause of otherwise good businesses failing. When evaluating liabilities, 3 ratios are particularly useful. First, the current ratio, current assets divided by current liabilities. This tells you if the company can pay its short-term bills. A ratio above 2 is strong, meaning the company has twice as much current assets as current obligations. Below 1 is a yellow flag, potentially red. If a company can't cover its short-term debts with short-term assets, it faces liquidity risk. Second, debt-to-equity ratio, total debt divided by total equity. This shows how much the company relies on debt versus shareholder funding. Under 1 is conservative. Above 2 means the company is heavily leveraged. Third, debt to EBITDA, which we covered in the dividend analysis video. Under 2 is ideal. Above 3.5 is concerning. The single most important red flag in the liability section is current liabilities significantly exceeding current assets. That means the company may struggle to pay its bills in the next 12 months. And if total liabilities exceed total assets, the company is technically insolvent, meaning shareholders' equity is negative, which is a serious warning sign. The third section, shareholders' equity, represents what's left over for the owners after all liabilities are paid. It equals total assets minus total liabilities. This is also called book value. The equity section has several components. Common stock and additional paid-in capital represent money shareholders initially paid when shares were issued. Treasury stock appears as a negative number, representing shares the company has bought back from the market. Buybacks reduce equity but can be positive, showing management believes the stock is undervalued. Overall, shareholders' equity trending upward over multiple years is a positive sign of a company building long-term value. Declining equity over multiple years is a warning sign worth investigating. Let me show you a simplified complete balance sheet for a fictional company XYZ Corp. On the asset side, $50 million in cash, $30 million in accounts receivable, $20 million in inventory, for a total of $100 million in current assets, plus $200 million in property and equipment and $50 million in intangibles, for a total of $250 million in long-term assets. Total assets, $350 million. On the other side, current liabilities of $40 million, long-term debt of $100 million, other long-term items of $10 million, for total liabilities of $150 million. Shareholders' equity consists of $50 million in paid-in capital and $150 million in retained earnings, for total equity of $200 million. Check. $150 million liabilities plus $200 million equity equals $350 million total assets. It balances. Perfect. This is the fundamental structure you'll find on every public company's balance sheet, scaled to whatever size the company happens to be. The logic and structure never change.
Here are the 5 key ratios I calculate from every balance sheet I analyze. Ratio 1, the current ratio. Current assets divided by current liabilities. This is the most immediate indicator of financial safety. XYZ Corp's ratio is 2.5, meaning it has $2.50 of current assets for every dollar of current obligations. Comfortable. Ratio 2, debt to equity. Total debt divided by total equity. XYZ has 0.58, meaning for every dollar of equity, it carries 58 cents of debt. That's conservative and manageable. Ratio 3, book value per share. Total equity divided by shares outstanding. If XYZ's equity is $200 million and there are 10 million shares, book value is $20 per share. Comparing this to the stock price tells you whether you're paying a premium or a discount to the company's net asset value. Ratio 4, working capital. Current assets minus current liabilities. XYZ has $60 million in working capital. Positive working capital means the company can fund day-to-day operations without additional borrowing. A shrinking working capital trend is worth monitoring. Ratio 5, return on equity, or ROE. Net income divided by total shareholders' equity. This uses one number from the income statement. If XYZ earned $30 million, its ROE is 15%. Generally, 15% or higher indicates a strong business efficiently using shareholder capital. These 5 ratios can be calculated in under 10 minutes from any balance sheet. Where do you actually find these balance sheets? 5 free sources. First, sec.gov/EDGAR. This is the official U.S. regulatory database. Every public U.S. company must file their complete financial statements here. The 10K is the annual comprehensive filing, and the 10Q is the quarterly update. Authoritative, free, complete. Second, macrotrends.net. This site presents historical balance sheet data in beautiful charts going back 10 or more years. Perfect for spotting trends. Third, Yahoo Finance. Go to any company's page, click Financials, then Balance Sheet. Quick and easy for a first look. Fourth, screeners like FinViz. These let you filter companies by balance sheet metrics, finding companies with low debt, strong current ratios, or specific book values. Fifth, the company's own investor relations page, the most accurate and detailed source directly from the company. My recommended workflow? Start with Yahoo Finance for a quick overview, use macro trends to see 5 to 10-year trends, then go to SEC EDGAR for the authoritative detailed numbers when you need to dive deep. Let me walk you through a real example using Coca-Cola, which we also used as an example in our dividend analysis video. Coca-Cola's balance sheet shows approximately $9 billion in cash and short-term investments, which is a substantial buffer. Total assets around $97 billion. On the liabilities side, approximately $67 billion in total liabilities, including $36 billion in long-term debt. Now, the current ratio is below 1, which on first glance looks like a red flag, but context matters enormously here. Coca-Cola is a 60-plus-year-old business with extraordinarily stable and predictable cash flows. Its current ratio being below 1 is a known characteristic, managed by sophisticated treasury operations. The debt to equity is around 2.2, which is higher than ideal, but again, Coca-Cola's unparalleled brand and pricing power make this debt very manageable. Most impressive, the return on equity, upwards of 35%. For every dollar of shareholder equity, Coca-Cola generates 35 cents of profit. That's exceptional and reflects the strength of the brand. The lesson here? Balance sheet ratios must always be interpreted in context of the business model, industry norms, and competitive position. A current ratio that screams danger for a manufacturing company might be perfectly normal for a consumer staples company with Coca-Cola's cash flow profile. Here's your 5-minute balance sheet checklist to use before every stock investment. Assets checks. Is cash growing or holding steady? Is accounts receivable growing slower than revenue? Is inventory growing in line with sales, not faster? Liabilities checks. Is the current ratio above 1, ideally above 1.5? Is long-term debt manageable relative to earnings? Is debt to EBITDA under 3.5 times? Has there been a sudden large increase in liabilities with no obvious explanation? Equity checks. Are retained earnings growing year over year? Is total equity trending upward over 5 years? Is return on equity above 15%? Score 8 to 10 checks positively, and you have a financially strong company worth investigating further. 5 to 7, and you need a deeper dive to understand the mixed signals. Under 5 positive checks, treat with significant caution. Always compare these numbers to the same ratios for competitors in the same industry, and always compare at least 3 to 5 years of data rather than just looking at 1 year's snapshot. Trends matter more than any single number. Let's recap what you can now do. You understand the 3 sections of every balance sheet: assets showing what the company owns, liabilities showing what it owes, and shareholders' equity showing what belongs to owners. You can calculate 5 key ratios: current ratio, debt to equity, book value per share, working capital, and return on equity. You know where to find balance sheets for free through SEC Edgar, Yahoo Finance, Macro Trends, and company investor relations pages. You have a 10-point balance sheet checklist to use before any investment, and you understand that context and trends matter as much as any single number. This is a genuinely powerful skill. Most retail investors never read a balance sheet in their entire investing lifetime. They buy stocks based on news headlines, social media tips, and gut feelings. Now you can go deeper. You can look at the actual financial foundation of any company you're considering and make an informed judgment. The balance sheet doesn't lie. It shows you what's really there, not what management claims in press releases. Use it every time. If this video gave you the ability to read a balance sheet for the first time, please hit that subscribe button and turn on notifications. Every week on the Investing Whiteboard, I break down investing and financial concepts this simply using real experience from over a decade in the markets. In my next video, I'm teaching you how to read an income statement, the second of the 3 major financial statements. The income statement shows whether a company is actually making money, how efficiently it operates, and whether its profits are growing. Together with the balance sheet, the income statement gives you a complete picture of a company's financial health. Drop a comment below and tell me, which company's balance sheet are you going to analyze first using what you've learned today? I'd love to see what you're researching. If you want me to walk through any specific company's balance sheet in a future video, suggest it in the comments. Thanks for watching. Remember, the best investors don't just buy stocks, they understand the businesses behind those stocks. The balance sheet is your foundation. See you in the next one.